Roundtable. I'm Tom Nunemaker with our guest Mark Alpers, who's going to talk about Weirdors in a low volatility environment. Before we get started, a quick disclaimer that Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss of trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. So with that, Mark, welcome. I think this is the first time you've spoken at the roundtable, but I think we've kind of known each other through the Sheridan community, if I'm correct, for a while.
Yeah, that's right. I did one presentation for Himanshu's trading group when he just was, I think the first trading group meeting he did, but I haven't participated in this type of session before.
Well, we're happy to have you, and you can go ahead and share your desktop anytime now and get started. I think we have a lot of Weirdor traders in the group, so I think we're all looking forward to this presentation.
All right, well, just first by way of introduction, the Jeep, I traded what's called a Jeep, and it's pretty much the original version of this trade as it was introduced by Jim Riggio and Paul Demers several years ago at Sheridan. I might have started this as far back as spring 2012, traded it for a few months, thought it was a little slow, didn't make that much money, thought I could do a lot better with some other trades, so I ran away and did some other trades for a while. And once I got smacked around on those, I came home to the Jeep and have been trading it ever since. It is, as far as my trading style goes, this is a very low maintenance trade. Usually doesn't take a lot of adjustments or anything. The downside of the trade is it's not that, compared to other trades, the yield and the profit is not that great. You know, if I can get 3% plus or minus a month, I'm more than pleased with this. But it's, I've been through a lot of different markets with it. I've been trading it now straight for 2.5 years. My last loss was probably in, I'm not sure it was January or I think it was a February expiration of 2014 when the market took a pretty big dump. I was down close to max loss. I wound up losing 2%, which I considered a huge victory at the time. And since then I haven't lost, but full disclosure, last October when the market dumped 10%, my wife and I were celebrating our anniversary out of the country, and I didn't have any trade on, so that might have helped my win-loss record a little bit. What you see in front of you is my normal setup if I were going to do it today on the rut. You can see the 1130, 1110 put spread. The 1130 is approximately, it's a little less than 10 delta right now, the short. It's the same on the call side. And the dollar amount you see for the credit is sort of pretty close to the minimum amount I would go into a trade with. Now, I wouldn't put a trade on today because the RVIX has been crushed over the last few days, and you know, I'd like to see a little wider strikes as vol goes up, and it's 60-some days to September expiration, so I still have time before I need to put this trade on do or die. I usually start one in the high 50 DTE area and then one in the low 50 or high 40 DTE, and right now I'm trading one in a portfolio margin account and one in a retirement account, which affects the way I trade them a little bit depending on which account they're in. Anyway, what you see here in front of you with the 48 to 16 is 48 put credit spreads and 16 call credit spreads. The normal starting ratio I would adjust it a little bit to get flat delta as I actually enter the trade. I protect it with one, for each 12, one tranche, or minimum size for this trade is 12. And I use one debit spread a little bit. I use it at maybe 15 or 10 to 15 points below the money to protect the put credit spreads. And one of the things that Jim and Paul taught, which I have abandoned over time, is the need to buy what are called teenies, or crash protection insurance, where you buy maybe a 2 delta put or 1 delta put, 2 delta put for each tranche that you're trading. I decided that it's easier to spend the same amount of money I was spending for teenies, which normally don't help you that much, to buy the 1 put you see there. I usually wind up spending about $600 for it. You see it going for 610 here, and it usually goes about 10 points in front of my short puts. And having a 1 protective put with a little bit higher delta than, say, 4 teenies way down at 2 delta, if the market moves down fast during a trade, this put will help me more. The one thing about it, however, is you sort of have to get your money's worth, or so to keep the yield where I want, which, by the way, is about 5%. The amount under the hood here is, I think, let me see, I'm having a little computer problem here, but it's a little under $4,000. I'd like it to be a little bit above $4,000 for 4 tranches, and the margin over here, you see his portfolio margin on a Reg T, it's about 88,000. So 4,000 out of 88, I think, is pretty close to 5%, and that's what I'm looking for, the yield under the hood here. I'd rather not have very much less, so I don't want to pay a whole lot for a put here, and it may not make sense if you're trading smaller size to spend this much for protection. You may want to go back to the old way, which was just to buy a crash protection put, which helps you during crash, maybe if the market really crashes hard, but not really going to do that much good in just a normal pullback. In any event, this is just a demo trade. This is just the setup, and I can show you now a couple trades that I have on, and which are both August trades. Hang on a sec. Get rid of those. Okay, this is my August trade. When I first talked to Tom, I thought since we were just sort of in our normal market moving its way up type of a mode, or even sort of the choppiness we've seen over since the beginning of the year, I thought that it would be good to have a presentation which talked about trading the Jeep in a low volatility environment. And then, of course, a few days later, the RUT did not cooperate by going, the ARGX going up to 21 plus. So this is the first time in several months I've had to even really do many adjustments to the trade. Very simply, well, this was the first time in a long time I sort of scratched my head and said, well, now how do I defend the downside again? This is my portfolio margin account, which allows me to do a couple things you can't do in Reg T. So my normal defense, you can see here, I think, that at the current price, which is 1272, right, I've got positive 10 delta, position delta. My adjustment point for this with 4 tranches on would be 80. Actually, it would be higher than 80 because the protective put I have on gives me a little bit more protection than the teeny. So I probably wouldn't look to adjust until it was closer to 100 here. But my first adjustment, would be to use, I don't know if you can see this combo trade down, about halfway down. I've got my cursor over it. It's a split strike. Go ahead.
We can see that.
Okay, my first defense here is to use a split strike combo. What that is buying a out of the money put and selling an out of the money call, and trying to do that for futzing around with the strikes, futzing being a technical term, to get to about a $2 credit. I only use one in this case. Usually if the market, because you use one combo per two tranches is the general rule of thumb. So I only needed one here, and also I think there was a Friday night when I wasn't sure whether to adjust it at the close of the market, so I did the other type of downside adjustment, which is more traditional, which is just simply bought back a couple of my my short puts to cut my delta. So I think I did that first actually this time. I bought back the puts, and then the next time the market went down, I sort of did the other half of the adjustment by putting on the combo. With a long put and a short call, a combo can be sort of a handful to manage. So you need to pay close attention to it if the market goes up. It's a lot better than buying back shorts in the sense that it doesn't hurt your theta as much, and it doesn't quite ruin the Greeks of the trade the same way just buying back short puts would do. But it's very effective if the market moves down, and because you're getting a lot of negativity with a long put, maybe 20-ish delta, and a short call also about 20-ish delta. You're getting a lot of downside movement there. But you got to watch that quick if it goes against you, because you've got a naked call, and at a certain point in time, the T+0 line is going to start to slope pretty dramatically. So I'm constantly monitoring the combo part of the trade when it's on. In any event, the normal adjustment point is 20 delta per tranche, and you cut your deltas in half, whether it's by buying back shorts or putting on the combo. I know that other people trade it by using debit spreads, put debit spreads. You can do that too. As I said, I've just always traded this way, the way it was originally presented by Paul and Jim, and I've been pretty comfortable with it, been trading it for over a couple of years period. This trade has been on since, I think it's June 26th, and so that's like 3 weeks, and most of my trades have been coming off before the next one goes on, which is nice, not to have them overlap, but this one's going to be on a little longer, but I'm hopeful. At one point today, it looked like I was up enough where I might be able to squeeze out of it by early next week. I'm looking hopefully for about 3K, but I'm not sure I'm going to get there. At this point in time, I've got, hang on, whoops, is that the right, what happened here? Never mind, here we go. I've got standing orders to take off the call spread when they get to 21, take off the put spread when they get to 21 cents, and I have a stop loss on the, which is what I want and why I turned to this page. I have a stop loss on put debit spread at about 380, which is just sort of an arbitrary number when I figured my put credit spreads will be so far out of the money that the put debit spread isn't going to really help me very much. In any event, today's adjustment, I think, was to buy back one vertical already. I started with 4, I've got 1, and that raises the hood. and I may sort of ease out of those one by one if the market goes up more, although you would think after several days going up, we might be due for at least some choppiness or a little pullback, but, you know, who knows? Whatever happens, happens, right? But by getting rid of the debit spread right before, within a week or so of when you intend to exit the trade, you can get a little bit more under the hood, which helps at this stage of the trade. I see the question about repeat the delta you choose in the combo trade. There is no, what I'm trying to do is, and I hope I don't get this backwards, but I'm trying to do a negative call, a combination of a short call and a long put for about a $2 credit. And usually the put is, I think maybe, I do it by price rather than delta. The call usually winds up in the 20s, I think. And the put is also either in the 20s or the 30s. But I just mess around with the strikes until I get the credit I want. And that seems to be the magic charm to cut, and also that has the effect on the deltas. I want to cut them in half. But it's sort of trial and error to find the right strikes because it's a split strike on that trade. Now, if you're in a Reg T account, what you have to do, because you can't do a combo because you're naked, you know, you've got a naked call, you have to buy a out-of-the-money call, as far out of the money as they'll sell you one for almost nothing, and then with the same type of combo trade, so that when you add in a short call to the long way out of the money call, you're basically creating a call credit spread. And then it's a call credit spread and a long put, which are both fine in Reg T, but in any event. Let me show you one more trade. This is a little bit different situation. Okay, this is my retirement account one. You can see by the risk graph, I think, that there's the calls have already come off this. The market went down a bunch, and I just, when I start the trade, I put resting orders on for both credit spreads, and I put a stop loss on the put debit spread. So the calls are off here, and this trade I'll probably be in for a while. I think these deltas are pretty screwed up right now. I think they're sort of, these after the market deltas are not good. I think I have maybe 30, 40 delta in this trade. At least that's where I thought I was when right before the close. The difference here is I did not go use the Reg T combo version. I bought back a bunch of short puts, and as the market has gone up, oh, I see what's wrong. I don't have in the two that I sold today. Hang on, I can do that in a second. Sorry about that. I'm having beach ball issues with my Mac. All right, so that's the trade, and that's closer to what the deltas are. I have now sold back all of the puts that I bought. My rule of thumb with this trade is, by the way, and this is sort of a John Lockeanism, which I've, well, I use two of his principles in doing this trade, which I found very helpful. One is keep my grubby hands off the trade until the last hour. You know, especially in the choppiness we've seen, this saves you doing a lot of, unless it's absolutely necessary. But this saves you a lot of whipsaw, and especially when you're selling back puts and calls, you can screw up a trade pretty easily by getting whipsawed. So I wait until the end of the day. And the other version, the other lock principle, which I've adapted or bastardized, whatever's the right word, is that I will sell back puts. I will never resell calls. You know, the market we've been in for the last few years has just been too much upside, and the issue is getting off your calls soon enough rather than reselling them. I've done it a few times, probably with calls in the past, and I don't remember getting bit that bad, but I think it's good practice not to. And if I'm making money early enough in the trade and my puts go maybe down to 6 delta or below, I'm sorry, 4 delta or below, very early in the trade, I'll consider a butterfly roll of the puts just to roll some or all of them up a bit to put a little bit more credit in the trade, assuming I can get more than 50 cents for that roll. In any event, upside adjustments, you know, it's funny, during 2013, that's all we were doing was upside adjustments, and was a large part of the frustration with the trade. What I've used for upside adjustment point is when I enter the trade, I mark down the premium I get for the short call. When I get, in the first 2 weeks of the trade, if I get to 1.5 times that premium, I sort of look to see whether I need to adjust. That doesn't mean I do adjust. It means I look to see. If it gets up to 1.75, I will adjust. And the adjustment can take two forms: either peel off the calls, some of your call spreads, or what I've done now in the past, and several of us have done or used to do when we had to defend the upside more, is to buy what is called a snowplow, which is to buy one call 20 points inside the your short calls for each 2 tranches you have on. And that gives you a little Mickey Mouse here, like you sort of see the beginnings of here. This is my long put here, but you get that type of a thing on the call side of your risk graph, and that lifts the T+0 line and at least gives you more time before you have to do something about your calls. But it does eat into your credit, as does everything. The other general point I'd say just overall is I mentioned at the beginning, you know, I want to get at least 5% under the hood at the start. This is a very credit poor trade. You know, I'm trying to get at least $1,000 per tranche at the start, if not more. And of late, I've sold a little higher delta to get that more, and that has obvious risks. You know, if I can average 750 to 800, I'm more than pleased. If that's my profit, that's great as far as I'm concerned. So 750 times 4 is a 5 tranche trade, so about 3750. You know, plus whatever I need to cover my commissions. And when you trade this size, obviously you got a couple $100 or so in commissions per trade. So that's more or less it. It's simple. It really, you know, during the first 3 or 4 months of this year, I have not had to make very many adjustments at all, if any. And it's nice because I do some more short-term trading, and where I do have to watch things more closely. You know, this can be pretty much set up with resting orders and stop losses and alerts, such that you know, it doesn't. I can tell when I get up in the morning whether, you know, I'm really going to need to adjust it, and allows me to focus on some other things, and while at the same time putting steady money away. for a good period of time now. So I like the trade. Somebody said, what month did I start with? What's up on the chart now is the August trade. Do I wait for a downturn to enter the trade or just put on schedule? Yes, I wait hopefully for more than one down day to get a little VIX pop to get it on, but I get it on one way or the other. I've had, there's another trader in the community who I talked to a bit who does a similar trade. He uses a calendar on the upside to sort of cut his Vega exposure a little bit and help him when the market goes up. We both agree that, trying to find the right entry date is sometimes hard, especially when the market's going up, 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 the volatility is going down, 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 and you're looking for as wide a strikes as you can get, to start the trade. So, I have a window that I use to put on each trade, and so the trade will be on by hook or by crook by that day.
And you said you started about 55 days or so for your max?
I'll start one about 55 to 60 days out, and then the other one will be about 50 days out. I like to space them out by at least a few days, if not a week. This one, the 2 August trades I have on now are only, I think I put on one on a Monday and one on a Friday, which is as close as I've been in a while. And it really did affect the trade. I mean, obviously a lot of it is just luck of when you start. Because this trade, you see in front of you, was down about $6,000 at one point. The other trade, which I showed, was down about $4,500, which, is proportional to the size of the trades, which is about as much loss as I want to take on one of these guys. But my deltas were okay, even though it was mostly Vega that was killing me. I wasn't really, my delta was never really getting that high. I only had to do one adjustment on this trade and one full adjustment on the other one. And I've certainly been through trades where on the downside I've had to make at least 2 adjustments when it's really gotten ugly. So in any event, both of these trades are sort of back from the dead in the last few days as the markets come up, and the vol has just simply died, completely, which is just wonderful for this trade.
So I had a couple new questions. Stephen asked, do you only trade the rut?
I have tried unsuccessfully, as have a couple other people, to adapt this to the SPX. And I'm not sure I know why. It backtests wonderfully, as, a lot of things backtest wonderfully, I guess. But in live trading, I couldn't make any money or I couldn't lose any money on it. It wasn't the same trade. I don't really have a good reason, but I know that a couple people tried to do SPX trades sometime last year. I was one of them, and I don't think it worked out for anybody. So yes, I'm back at the rut, and I do another rut trade also, but whereas a year ago, almost everything I was, aside from this trade, I trade the SPX. So,
what would you say your average is over the last? You said you've been trading it a few years, so have your returns been about the same, or have they gone down recently, or how are your results?
My results have sort of improved from maybe a couple years ago, being lucky to get to 2%, but getting 2% all the time, to getting upwards of 3 or so. That's my average right now. Like I said, I haven't had losers in a while, and the last loser I had was less than 2%. It was less than the amount I normally make, and So this is not this is not a lucrative trade. This is slow and steady wins a race, not, if you're looking for lottery tickets. And that's one reason I like it. It's a stable trade that allows me to focus on stuff that's less stable, or, I do a lot of short-term directional trading with diagonals and credit spreads and all, where I'm more involved in the day-to-day stuff. So I'm just as happy to have this thing just sort of operating on cruise control in the background. It's been sort of that way.
And Bhaskar asked, did you say your adjustment on the downside is 20 position delta per tranche?
Yes, that's correct.
Okay.
And on the upside, it's a function of the price of the short put, where, it's about 1.5 to 1.75 for the first 2 weeks, and then as you get into the trade or longer into the trade, you adjust, or you get rid of your calls if they get above what you sold them for. But there's sort of a sliding scale that I use for that. But I haven't really had to do that, to tell you the truth, late.
Brad Hartman had kudos for you. You said it was a challenging month with the drop and rebound. You handled it well. So that's,
Brad trades it a little differently with some debit spreads, and he's been trading it almost as long as I have, and he probably gets better results. But hey, he's Brad, and I'm not.
Everybody trades it their own way, right?
That's right. Well, and then, I'm sure he'd agree that we both personalize the trade, and I haven't done that much to it except tossed out the teenies, and I do look for a little higher delta on my shorts now when I enter the trade. I just to jack up the yield a little bit, and if you're defensive enough with it, it's and if there's sort of, I don't know, I don't want to sound trite, but you can't, especially on the downside, obviously you can't wait too long to adjust. If the market goes bad, you want to jump on it. But at the same time, the other thing that's really helped me, I think, not get whipsawed is the wait until the end of the day thing, because it's something I've just adopted, and it's sort of I've had a couple operator errors in the trades that I'm in right now that have probably cost a couple $100. In this trade, that means a lot, But on the other hand, the trade's pretty forgiving. But the last thing you want to do if the market's moving down is not adjust, But the question is when. Usually we adjust at absolutely completely the wrong time when the market hits it slow, and then it turns around and you just spend a bunch of money adjusting your trade you don't need to. Or you just sold back a put and the market goes down against you again. You can get cut to ribbons like you can on any butterfly trade or condor trade where, you're trying to move with the market. But, anyway, it's been a good trade for me, and I like it because I don't have to, it is something that I've just had consistent results, and I'm not afraid to trade it. I've been trading this size for a long, long time, so, that's not an issue. I don't have any real inclination to go to make it that much bigger. I often have two trades on at the same time, because they overlap a bit in terms of month.
Marilyn and Andrew kind of had similar questions. Is your decision to adjust the trade ever based on how long you've been in the trade, and would you ever take when the call side's off, would you let it expire?
The answer to the second question would be yes, provided I had enough room. Yeah, I've done that in the past. It's been a while because the market hasn't been moving up the way this year, the way we've seen it in the past, where like in 2013, where we woke up every day and it was, how many points is it up today? Your shorts get so far behind you that you can't expire, and I would do it, and I have done it in that situation. And to be honest with you, on the other question, if I can get a trade off and I make about 3+% on it, if I can get that trade off before the next one goes on, I'm going to do it. Yeah, just for simplicity's sake. And that's usually, and which is right about now, by the way, on both these trades. You know, I want to get into my September trades in the next 2 weeks. So yeah, I'll cut them a little short sometimes if I'm satisfied with my return and I'm running out of time to get on the next month's trade.
And Ivan asked on that 20 delta, position delta, is that in toss or option view? It looks like toss.
You know, toss pays you, so yes. I use toss. I don't use option view. I don't. My wife uses one, but I rarely use it these days. So you know, with this isn't. I don't know. I've never heard this. I mean, I'm familiar with the discussion that, you know, it goes on about the deltas as between option view and toss, but I've never had. I've always just used toss.
Very good.
Better or worse.
I think Brad said he agrees. You know, there's quite a few people that trade in their own way, and they all seem to be doing well. I know Amy's doing well with her Weirdor signal service, so it's a very popular trade and very forgiving, like you said. That was one of Dan Harvey's design goals for the original Weirdor.
Well, you know, when I started with Sheridan way back when, one of the first trades I liked and I traded for a while was Amy's trade, and that was an okay trade. The biggest difference is, and this is not editorial, it's just, but it's sort of my view on it is, this trade is, you're all in from day one in terms of dollars. You know, you may increase your margin 10% over the course of the trade. The nested condor is more martingale, so is the Jay Hansen one, where, you know, you might wind up with 4 times the margin you started with. So you know, being a fraidy cat at heart, I prefer this trade. But anyway.
Yeah, one thing I like, when you add more put debit spreads in your defense on the downside, it starts reducing the margin, which is pretty neat.
Yeah.
Okay, I don't see any more questions. Do you have any? Okay, Bhaskar asked, how is it different from Dan Harvey's variant? I don't know if you've seen what Dan Harvey's doing lately, Mark, but Dan's basically adding some calendars around the spot price, I think, to help lower the vega and give them a little bit more theta near the money.
Well, I'm doing a version of Dan's Twin Peaks. I haven't done it since the Greek news has hit the TV and the candles have just gotten too big. But I do about a 30-day trade where rather than a condor, you've got broken wing butterflies on each side. About the same ratio, you know, 2 to 1 or 3 to 1, puts to calls. And again, I know Dan Harvey is, I think he may have started with the SPX and moved to the rut, but the last time I heard him talk, he was trading the rut. And I was doing well with that trade. You know, it's a lot smaller trade for me, and I like it because of that. I was thinking of starting one tomorrow again. It's been several weeks since I've had one on, but I like that trade a lot, and that I do more on a weekly basis, where start them about 30-plus days to expiration, and just make sure I have them on different expiration cycles in this trade so I don't step on strikes and stuff between if they're in the same account.
Yeah, I think Dan's doing them every 2 weeks, so he goes 30 to 35 days out using weeklies, and he just always has 2 on.
Yeah, I haven't started using the calendar. Is he using calendar on both sides or just put side?
He always puts one on the put side. He said the call side is optional, so I think it depends how he feels at the time.
Well, I listened to you guys talk about, to Dan and you talk about his trade. I read the Brian Johnson book, and I haven't quite implemented that. I've got his spreadsheet, yeah, I've started trading that live in January, and was making 4 or 5%. The way I trade it, though, I'm not the artist by a long shot that Dan Harvey is, and I'm certainly never will be. But my way of trading that was basically if I got to 5-6% on the upside, it came off, and if I got to 4-5-6% on the downside, it came off. But the problem with weekly or biweekly trades is enduring big losses that are outsized what you make or twice what you make. So I'm just avoid that by any means. So, but my results on the trade have been decent.
Very good. Well, there's no more questions, so I want to thank you, unless there's anything else you want to talk about before we wrap it up, Mark.
You want to buy a desert island in Greece? No, I'm done. I'm talking about enough.
Okay, well, we really appreciate it, and we still have plenty of time if there's any more questions, but I think that's pretty much it. So no harm in ending a little bit early since we've got everything done, and really appreciate you showing us your trades, Mark, and your variant of the Weirdor.
Thank you, Tom.
Oh, we had one last question for Brad. How did you do last October with the V move?
Well, Brad, Debbie and I were celebrating our 30th anniversary, and so we were up in Whistler and Vancouver and didn't have a trade on, so I did great on that trade. But I didn't make any money. I sat that one out.
Okay, and then I guess this is the last question. When you say 4 to 5% upside downside, is that ROI or ROE?
It's return on maximum risk as shown on the risk graph. Whatever
Perfect.
happens, if I fall into a coma on the risk graph, is the absolute most I can lose.
Right. Okay, well, thanks again, everyone, and let's call it a day. And I think we've got, next week, we've got Ron Bertino speaking on Weighted Vegas. That should be a nice presentation, too. So thanks again, everyone, and we will see you next time. And thanks, Mark.
Thank you.